Imagine waking up every single month to an extra $1,000 hitting your account, not from a boss, not from a side hustle, but from investments quietly working in the background while you sleep. That's the promise of dividend income, and while it might sound like something reserved for millionaires or retirees with massive 401k balances, the truth is you can start building toward that goal with as little as $10,000. The real question isn't whether it's possible, it's how you structure your portfolio, manage your expectations, and use time to your advantage in a system designed to reward patience. Let's start by grounding this in reality. $1,000 per month dividend income equals $12,000 per year, and if you're starting with $10,000, you're not going to hit that overnight unless you take extreme risks that could wipe you out. What you're building here is a compounding machine, not a lottery ticket. Most high-quality dividend stocks in the U.S. market yield somewhere between 2% and 6%, while higher yields often come with higher risk. So instead of chasing unrealistic returns, the smarter approach is to combine solid dividend-paying companies, reinvest your earnings, and gradually scale your portfolio over time. Now, here's where the magic starts to happen: reinvestment. Every dollar you earn in dividends should be reinvested back into your portfolio, especially in the early years. Many brokerage accounts in the U.S. offer DRIP, or dividend reinvestment plans, which automatically buy more shares for you. This is where compounding kicks in. Your dividends buy more shares, those shares produce more dividends, and over time, the growth starts to accelerate. It's not flashy in the beginning, but it becomes powerful as the years go on. Another key piece of the puzzle is yield versus growth. It's tempting to chase stocks with extremely high yields, sometimes in the double digits, but those often come with hidden risks like unstable cash flow or potential dividend cuts. A more balanced strategy focuses on companies that not only pay dividends, but also grow them over time. These dividend growth stocks might start with lower yields, but they increase payouts year after year, helping you stay ahead of inflation and build a more reliable income stream. This is especially important when you consider taxes and IRS regulations, because qualified dividends are often taxed at lower rates, making them more efficient for long-term investors. At the same time, you need to consistently add to your portfolio. Even if it's just a few $100s a month, that contribution dramatically speeds up your progress. Think about it like this: your $10,000 gets the engine started, but your monthly contributions are the fuel that keeps it running. Pair that with dividend reinvestment, and you're creating multiple streams of growth, all feeding into the same goal. This is exactly how many investors eventually reach that $1,000 per month milestone. You also want to think about where you hold these investments. Placing dividend stocks in tax-advantageous accounts like a Roth IRA can allow your income to grow tax-free, which is a huge advantage over time. In contrast, holding them in a taxable brokerage account means you'll owe taxes on dividends each year, which can slow down your compounding. Understanding how to position your assets across accounts is just as important as picking the right investments. As your portfolio grows, you'll start to notice something interesting. The income begins to feel more stable, more predictable, and more independent from your day-to-day work. This is where the psychological shift happens. You're no longer just saving money, you're building a system that generates cash flow. And once that system reaches a certain size, hitting $1,000 per month stops feeling like a distant dream and starts looking like an inevitable outcome of staying consistent. In the end, building a $1,000 per month dividend portfolio starting with $10,000 isn't about quick wins or chasing hype. It's about discipline, smart allocation, and letting time do the heavy lifting. If you focus on quality investments, reinvest your dividends, contribute consistently, and take advantage of tax-efficient accounts, you're stacking the odds heavily in your favor. The people who reach this level of passive income aren't necessarily the ones who started with the most money. They're the ones who stuck with the process long enough to let compounding work its magic. And if you start today, that future version of you collecting monthly income might be closer than you think.